All right, welcome to the March 3rd, 2023 edition from News from the Front Lines of Business by DW Huff Consulting. I'm David Huff, CPA, owner of the firm here, and I'm just going to jump right into it. So, just based on some discussions we have with clients, and we're definitely in the full swing of tax season here. Things are busy. IRS is processing things a little bit more quickly than last year, so we definitely are happy with that. And but as we kind of go along, we talk to people. We have a lot of topics that come up that we feel like could be useful to everybody. So we'd like to kind of recap those things on our News from the Front Lines podcast every week. So here we go. The three topics for this week are the self-directed IRA strategy, a little bit more clarification there, a little inflation chat, as well as the Berkshire Hathaway meeting notes. So that was something that happened last week that was always interesting. But on the self-directed IRA, so we always talk about that, and you may see us referring to it all the time as a way to manage real estate. So we always, like this because it gives you more options. So on the left-hand side here, we see, which traditionally done, stocks, bonds, mutual funds, so stuff with your brokerage account with Fidelity or whatever. And then on the self-directed, we have more real estate, private companies, etc. So real estate would be, I guess, the most common thing that's used. So we like, rental properties, commercial, and stuff like that. However, another topic that encompasses is actually, private notes and mortgages, for, being something else that's easily done. Because once that money is in that IRA or the Roth IRA, whatever vehicle you choose, you can now turn around and lend that to people. And there's procedures you want to jump through, hoops you want to jump through as far as notes and mortgages and attachments and that sort of thing. However, there's a way to get a higher interest rate than you would at any bank or even any kind of corporate bond or anything out there really. So that's risky, and it is a business, and like everything else we talk about in that self-directed space, it does require a certain amount of work, but it is another possibility. So since that question came up this week, I figured we'd recap that again. All right, so this inflation illustration. So earlier this morning, I went to buy a candy bar at the Walgreens and Hershey bar, and it reminded me of this old study I saw a while back, and they call it the Hershey Bar Index, and it goes to show you, I guess, it illustrates inflation. So there's a number of just baskets of food goods that are in this particular study. But over here we look at the Hershey bar, so that's pretty easy for me to wrap my head around. And it goes all the way back to 1908, so you see back then you got, instead of the 1.45 ounce bar you get today, it was half an ounce or whatever, and that's 2 cents, 3 cents, etc. But the most recent year that was tracked in this particular study, that 1.45 ounce candy bar was 40 cents. All right, so today that bar was $1.79. And the reason why I guess this is worth noting is that we had, back in 1986, you had a $10 bill, and you wanted to keep this particular $10 bill in place to buy some candy bars down the line. So you like candy, and you wanted to save your money for it, and so back then you might have thought you were pretty well off. That $10 bill would have bought you roughly 25 candy bars. That's a lot of candy. All right, so if you did not invest that money, and if you just put it in a coffee can or under a pillow somewhere, and pulled it out today and went to Walgreens to go buy a candy bar, or as many as you can afford, you would have 5.5, call it, of Hershey bars. So a lot less sugar for your money there, right? So the takeaway here is that if you put it in a bank account, right now interest rates, we've seen them very low. Historically they've been higher than they are now, but those interest rates are very low. So who knows, that $10 might have been $12, $15. Maybe you got 10 candy bars, but nowhere near the 25 you would have had back when you first started. So just it stresses the importance once again of staying ahead of inflation. So on the past couple of weeks, we've talked a little bit about those I bonds and how we have an interest rate component there as well as an inflation component. So if that inflation component adds to your interest and keeps you, keeps that $10 growing at least as high as inflation, you could have still bought 25 candy bars and maybe even a little bit more with the interest component added to the inflation. So that's the takeaway knowledge here. $10, 30 years ago is not $10 today, and here's how much less candy you could have bought for that same $10 bill. So anyway, all right, so Berkshire Hathaway. So in the news lately, they had their annual meeting. I believe it was about a week ago, maybe 2 weeks. As a part of that meeting, they talk about the performance of the stock. So right now, it's at the B shares, the lesser Spencer shares, about 309. And here you can see how I just showed the 5-year chart here, and how it went from roughly $210 now to the 309. So pretty solid growth as expected with the Oracle of Omaha calling the shots. But he also talks, I think, about other topics that are of more interest to the general investor. Some macroeconomic kind of things, as well as this one talk about just capitalism. So as we see with the current, I guess, temperature of the administration here in Washington D.C., we talk about raising corporate tax rates, and you'll hear these sound bites here and there where they're talking about corporations paying no tax, or less tax than the some low level low wage earner individual somewhere. And here we kind of talked about capitalism being a good thing, so it's not something we need to be vilified. And Berkshire Hathaway did pay, and they highlight here, $32 billion in tax. So Berkshire Hathaway owns a lot of companies like Geico, Coca-Cola, etc., and they've paid a ton of tax. So this sort of, I guess, stereotype that's being used where these corporations not paying tax and all the little guys are getting stuck with the whole bill is definitely not completely true. And the fact that they're using that as a justification for raising tax rates is also what I consider disingenuous at best. So anyway, so that's his talk on it. So I think we can't really argue the fact that capitalism, while it's not perfect, it does provide the most opportunity for growth of everybody's money. So everybody has access to the stock market, whether it's Berkshire Hathaway or a good mutual fund or whatever. Everybody has some access to that and has at least some ability to participate in it. So so it's still probably not perfect, but not an evil system by any stretch. He talks about a few of the things, and another topic he always goes back to is the importance of long-term investing. So we saw that in a slide a little while ago. How, you ride out the highs and the lows and the post-COVID downturn and everything, and inflation, deflation, recession, etc., and everything seems to kind of work out okay when you kind of take that ownership mindset with your holdings and let things do what they're going to do. So he goes on to talk a little bit about the companies in his portfolio and how they raise their prices to keep up with inflation, and everything kind of works out. So my closing thoughts here, we got just a couple thoughts. As we deal with really hectic times here, I'm reminded of the importance of kind of finding the quiet. So we talk a little bit, as things get stressful, how you just kind of jumping around back and forth, and sometimes you feel like you get a little overwhelmed with things. Well, here one of my favorite Marcus Aurelius quotes is goes on to emphasize the importance of allowing yourself a space of quiet where you can gain knowledge. So so we do want to try and find that space where you can think clearly, make good decisions, and go on. So in any case, that's it for this week. We'll definitely gonna hopefully survive another week of tax season here, and we will see you next week.